So we have our raw data here. If we look at it one by one, we have our comparables data, which looks very similar to the ones that we have used in our trading comps analysis. And for your information, these data we have compiled from Coifin. We also have data on the share prices of our peers. For your reference, we have 5 peers: Marriott, International, Hilton, Intercontinental, Hyatt, and Choice. These 5 peer groups. We also have a benchmark index, the S&P 500. We also have the 10-year Treasury yield, Treasury bond yields, 5-year average just in case. We also have the data from Damodaran, country-specific risk-free rates of almost every single company in the world. Of course, we're simply going to use U.S. Equity risk premiums, but this is where we can get the data for equity risk premium. We also have the sources, just in case if you want to utilize it in the future, and also a corporate tax rate for our tax rate calculations as well. Also, an income statement, a balance sheet, and a cash flow statement just to use to calculate effective tax rates. So back to our calculation spreadsheet. The first step, we're going to simply write and express the weighted average calculation formula. So the title will be weighted average cost of capital calculation. We're going to start from the debt percentage of total capital. In other words, the debt ratio. We're going to multiply the pre-tax cost of debt, and we're also going to multiply 1 minus the tax rate. And the equity part, we're going to calculate equity percentage of total capital times the cost of equity. And that's going to lead to our weighted average cost of capital. So this is going to be our title as usual. So let's color the cells. I'm gonna do black, and the font color is in white. Let's add some lines as well. So all right, so basically, weighted average cost of capital is going to be, let's add a parenthesis in the front just for clarification. We're going to multiply the debt percentage to pre-tax cost of debt times the 1 minus tax rate, added by the equity percentage of total capital times the cost of equity. Let's select the entire area and pre-format these cells in percentage formats. So this is going to be our final destination of our, task. And then we're going to add a couple more lines to do an equity cost of equity calculation. So let's add another title format. So this is going to be cost of equity calculation. And as mentioned in our previous slides, we're going to start from the equity, from the risk-free rate. We need equity risk premium. And we're going to multiply equity risk premium to the company specific beta. So let's just write selected beta. However, in actual practice, we often encounter other types of risks that are added to equity risk premium, cost of equity calculation. Sometimes we add a separate column for country risk. So any additional risk factors that the analyst thinks that should be considered. Size risk. So if the analyst thinks that this company is too small and has, and needs to be slightly adjusted accordingly, we could always manually add a size risk. Of course, I'm one of those people that don't prefer to add any numbers to the original formula, but let's just make the frame just in case if you want to use it in your future analysis. So you have size risk, and lastly, any company specific risk. So if any, and that's gonna lead to cost of equity. So again, a little bit of formatting. And these as well. Except for the beta, they're all going to be in percentage formats. So let's first calculate and do the formatting later. So it's going to be risk-free rate added by equity risk premium times selected beta, added by any specific country risks, size risks, or company-specific risks if needed. Control-Shift-5, Alt-H0 for formatting. And at least now we have, one reference. So cost of equity it's going to be linked to cost of equity. And now our task is to fill these areas one by one. And we're going to start from cost of debt.